welcome to another great podcast. This is Satavisa. For today's podcast, we have with us Ankur Bansal, co-founder of BlackSoil. Hello Ankur, welcome to Analytics Insight. It's great to have you here.
Hi, how are you?
Hi, I'm good. Now, please let me know about what is BlackSoil is all about.
Sure. BlackSoil is a credit platform. We have been focused on the lending activity for startups now for the last 6 years. We found there was a big white space available for startups as they grow back in 6 years ago when startups economy was still very small compared to where it is now. We felt that as they grow, they will also need debt. And that's where we believe that we should focus on instead of getting on the equity side as there were multiple players at that point of time. But lending is a very different ballgame altogether, and especially to startups which are loss making, especially when it is at the early stage of the businesses, not necessarily when they have become like unicorn stage kind of businesses. So we felt that there's a good opportunity for us to build a business out there, and that's how we started off. And it's been a good journey for us, been fairly active since we started off our business in 2016.
Well, that sounds great. Now, I'm interested to know about what must be the specializations and services that your company is offering.
So BlackSoil offers multiple debt solutions. We are a complete debt stack provider, from providing simple working capital loans to revolving capital lines. And we also now have a fintech business providing supply chain financing to startups. So three very different sort of products and structures, but basically idea is that as we partner with any startup at any stage of their growth, we should be able to take care of all their debt needs that they have. And we try to partner with them early on through a venture debt product. And as they scale further, these products can become more term loan kind of products, plain vanilla, or they can also be revolving capital lines. And in some of the cases where there are businesses specifically in B2B e-commerce space, they also look for more specialized supply chain solutions like vendor financing or merchant level financing or purchase invoice financing or receivable discounting kind of products. So those kind of solutions is something that we are providing currently to all our portfolio that we've been working with in the last 6 years.
Well, it seems you people are doing a great job. Now, please give me a brief about the investment outlook that you people are serving in the tech sector.
Currently, we have an outlook, or you're asking about as in specific for this year?
Yeah, that will be great.
Okay. No, so as an overall thing, obviously, we are very bullish on the overall technology tech-enabled space for Indian companies and Indian startups. Obviously, we feel there is a big white space available for each company, each startup that they're growing. Not the most easy businesses to execute. It seems easy to obviously raise a seed round or early stage round and get into the business. But the difficult moat is to obviously create a business model which is scalable in nature and which is sort of having a large addressable market size where they can really scale and be able to show hyper growth at the same time make money. So these are very difficult things to do. But across India, there are multiple businesses and multiple ideas that people are coming up with the internet penetration and our demographics being in space and capital no longer being a challenge. It's all about how high quality entrepreneurs can execute. And that's where we have seen now serial entrepreneurs coming in, doing deals, which they're able to raise multi-million dollar kind of seed rounds or able to raise very large Series A, Series B rounds because of having that execution capability. And I think literally every space that we think about in India, because we are such a sector agnostic country, each sector has so much to do with so much unorganized market being there. There's so much fragmentation now, so many products which are still yet to be utilized. Whether you take any sector, we know that there are a lot of big, large businesses that can be built. So even though currently, as we speak, the environment might be a little different for startups, as we started hearing about layoffs and we started hearing about the amount of unicorns that we expect this year to be made might be lower than previous year or last year. There was a very frothy valuation, but overall, if you look at 3-5 year horizon, we feel that the new innovation economy or the startup economy is going to add a lot to the country, and there is a lot of capital that can be utilized and deployed very wisely with some of these very strong entrepreneurs who are bringing a very different skill set to be able to find India problems and solve for them with a solution that works in India specifically. And more interestingly, a lot of these businesses, as they start executing in India and creating a name for themselves, are also able to now start taking their product or service or their solutions outside of India, where possibly the average ticket size that they can get or the margin that they can earn on those products and services is much higher. So that's the other space that we are seeing a lot happen, especially in SaaS, but we see that going to be happening in other sectors as well, where businesses start executing and showing that they can do business outside of India in regions like the Southeast Asia or even the Middle East. So there are a lot of opportunities for all kinds of equity investors as well as lenders like us to enable and provide the kind of capital that they need to be able to scale and find that orbit where they can go from one level to the other.
Thanks, Ankur, for explaining that so well to me. Now, if we want to talk a little further about the startups in India, can you please give me your inputs on the present scenario and how you are helping them? And if it
Yeah,
will be great if you can also give me some use cases or examples.
yeah, sure. So there are multiple use cases why people come for debt to us. One, the simplest one, which is going to be extremely active in the current market situation, is going to be bridge funding. So where people will come to take debt from us, where they can extend their current cash runway by taking like a 2 month, 3 month, 4 month, depending on the kind of burn they have, like a bridge round of debt from us, so that they can extend the current cash and ensure that the next round of funding happens possibly 9, 12 months from now, and not anytime soon. So a lot of these startups are raising a lot of bridge equity rounds, or they're raising equity rounds. They want to have a strapped on debt alongside, so that they are in a better position. They have enough cash in the bank to be able to avoid any difficult fundraising conversations, or they don't want to negotiate from a position of weakness. So the bridge round funding is something we see very actively. Second, which was very active, which will remain active, is the working capital lines, which comes in revolving line kind of products or regular term loan products, because all businesses which have any inventory, people have receivables or any kind of capex, it makes sense to utilize debt for that. So it's a very strong use case. And third one being acquisition financing, which is much more specialized, much more structured, where obviously we don't see now acquisitions going to be having the same pace that it was at the last 6 months. But still, people will keep doing strategically some acquisitions, and it makes sense to have some debt to finance those acquisitions, not to use your entire equity money for that. So these three remain the primary requirements of that. And of course, the big benefits of these products is that since it's debt, there is no dilution for the investors, as well as the equity holders, being like the founders, etc. And they can obviously create a much more disciplined organization and become more capital efficient by raising this debt. And if they are able to create a credit history, then if they become profitable, they can possibly even attract capital from traditional banks and BFCs, and even then lower their cost of debt.
Sounds really great. Now, lastly, I want to ask you, what are the future plans for this company?
So we are always raising capital in the form of debt, etc., or in our funds. So we have deployed last year alone to the tune of more than 650 crores across 30 odd deals. And in our last 6 years, we have completed more than 120 deals across 100 plus companies. So for us, we will maintain the same trajectory of growth. We'll keep raising capital, whether in our funds or in our NBFC, so that we have good amount of capital available with us to fund large companies or companies which have the potential to become quite large and are scalable in nature. So we have seen very strong interest on the debt side from companies which would have raised as small as $3 million, all the way companies who would have raised over 500-700 million dollars as well. So there is a strong interest for people to become capital efficient for the use cases I mentioned to you earlier. And we obviously want to be one of their early growth partners so that we can be part of their growth and, of course, add more interesting companies to our portfolio as we scale our AUM, which has itself grown, I think, more than 6-7x in the last 6 years.
That sounds really amazing. I'm sure this is definitely going to help all of our listeners too. Thank you, Ankur, for joining us today. It's been a pleasure talking to you.
Thanks for having me, Satavisa. So it was nice talking to you.
Yes, thank you.